Welcome back to QAV American Edition, Tony, episode 34. Happy New Year, our first episode of 2026. How are you?
2026, I'm good. Had a very recuperative week between Christmas and New Year. Reading books and playing golf.
That's lovely.
Yeah.
I was on the beach. Nice to be back in the office, though. A lot going on in the world. Obviously, we'll get into my deep dive of the week soon. But before we do that, obviously, a lot happening in the world in the last few days. The President of the United States sent some guys in to kidnap the President of Venezuela and his wife. The most interesting part of that, or important part of that from our perspective, is what it means for the price of crude oil, what it does to the markets in general. We just talked about this on our Australian show in some detail, but essentially, to recap, no one really knows what this means for the price of crude oil. It could go up, it could go down, it could do nothing, could go sideways. But one of the things that I said on our last show is we do track, for people that are new listeners, we do track about a dozen or so commodities, because a lot of the stocks, particularly in our Australian portfolio, are commodity stocks that we pay attention to. And we like to know where the commodities are because that informs our buy and sell decisions for mining companies or companies involved in commodities in one way or the other. And crude oil has not been a buy for us for some time, but as I pointed out in our last show, it is getting close to the buy line for us. I think the buy price for us for crude oil is about $65 a barrel, and it's ran about 61, 62 this morning, and moving up. So it could become a buy in the next week or two. We'll just keep an eye on it and see where it goes. If it becomes a buy, it means there's a lot of stocks in our buy lists, both in Australia and the US, become buys again. But we just play it day by day, keep an eye on it.
Yeah, so for new listeners, if a company is a miner or an oil producer or refiner or whatever, we use the underlying commodity as a buy and sell guide for us, because it doesn't always have a one-to-one correlation, but I found over the years that the trends have a pretty high correlation between where the underlying commodity goes and where the fortunes of the company which exploit that underlying commodity go.
And it's a bit of a lagging indicator.
Yeah.
So, yeah, if the price for oil starts to go up, then oil stocks will probably go up.
Yeah.
A little bit later, though. We can catch it a little bit early. And vice versa. If the commodity starts to drop, usually the share price will drop over time as well. The other story that we talked about is every Wall Street analyst surveyed by Bloomberg now predicts another stock rally in 2026 in the US markets. Again, from our perspective, that's interesting, but we don't really care one way or the other. If we play the market as it happens. If it goes up, great. If it doesn't, that's okay for us too. We just stick to our rules. Nothing changes. I said in my newsletter this week, at Kung Fu, Chrissy and I are saying 2026 is the year of the kicks because we're focusing on our kicks this year, improving our kicks. I was trying to come up with a similar motto for QAV. 2026 is the year of the, and I just got back to sticking to our rules and doing what we normally do. It's kind of boring.
Oh, you can do QAV on one leg if you like, if that helps.
I said QAV 2026 is the year of sticking to the rules, no tricks.
Discipline. Yeah.
Just to make a room with six.
No
tricks. No tricks. We got no tricks. Our trick is discipline. Yeah, that's the trick, right? Disciplined investing, rules-based investing. And it is actually it is the ultimate trick because, as we know, most investors, amateur and professional, really, really struggle to have discipline. It's probably the biggest. And, Buffett has said this, Munger said this, Ben Graham said this, Peter Lynch has said this. Who wrote the What Works on Wall Street book?
O'Shaughnessy. Is it Patrick O'Shaughnessy?
O'Shaughnessy,
anyway, yeah.
It was one of the big things he called out in that book from his experience is that even the professionals, if their system stops working, they jump horse midstream and try and get on the new horse. And he's like, no, you have your you have your framework and you just do it day in, day out, month in, month out, year in, year out. Don't change horses midstream. And, that's what we do. And it works.
We're the broccoli of investing, aren't we?
I am going to send you that Dana Carvey chopping broccoli thing as soon as I get off the show.
Yeah.
Chopping broccoli.
Well, 2026 is the year of no predicts. How about that?
Oh,
given what Wall Street are doing.
Nearly works. No predicts.
Which we don't do.
Well, we don't predict.
And
I think
look,
it was
if all those analysts got it right consistently, they wouldn't be working for Wall Street banks.
That's right. And I think it was Peter Lynch, his quote, people who live by the crystal ball end up eating shattered glass or something to that effect. So
that's a great quote.
It is a great quote. I like it. We don't predict. We just listen to the numbers and play things day by day.
Yeah, that we've worked out in advance that will work.
Yes. Rules that tell us when to buy, what to buy, when to buy it, and then when to sell it. And ignore everything else in between. Just follow the rules. Well, for new listeners, what I do on the show each week is take our buy list and take a stock off that buy list and talk about it. We do a deep dive, or what we call a pulled pork. Don't know why we call it. I think Tony said years ago, I'm going to pull apart this stock, and I said it was like a pulled pork, and it's just stuck. But what I have been doing for the last year or so is just finding interesting companies to talk about. But what I'm doing more recently, because we started the QAV Light portfolios, which is like a demonstration portfolio where I add a stock every week and then people can watch how we trade those. They can follow along, or they can just use it as a proof point later on. We have complete transparency. So you see what we bought it, why we bought it, what happened to it, when we sold it, why, all of that kind of stuff. I add a stock each week, and the one that I am going to add this week is the one that's at the top of our US buy list this week. It's a company called, it's a long, yeah, well, it's called XPLR Infrastructure, but the ticker code is XIFR. So I'm calling it XIFR.
This week we're brought to you by the letter X.
Yes. And like every week, it's an interesting story. So for stocks to turn up in our buy list, particularly to be at the top of our buy list, they've got to be going through a bit of a traumatic period. For people that are new, we're the kind of value investors that look for companies that are typically been around a while, relatively stable in terms of their underlying business, they're generating cash, but for whatever reason, we can pick them up at a discount to their valuation. They're on sale. What was that quote you had from somebody in our last show?
Oh, let me find it for you. Something like the stock market is the only thing that goes on sale and everyone runs away.
Yeah. But not us. We're looking for stuff that's on sale. And, if our system, if our checklist picks it up and says, you know what, this is worth paying attention to, then we pay attention to it. So this company...
Hang on. But not every stock at the top of the buy list is going through a traumatic event. There's plenty of stocks on the Australian buy list that are doing well, but they're just unloved or unlooked.
But that's it. Why are they unloved? Why are they not trading at a reasonable valuation? There's got to be a reason for it.
No, true. But like the pulled pork I did on the Australian show, which was a iron ore mining company, which was vertically integrated, and it was starting to take off. But why was it unloved? Because analysts just didn't value the road haulage side of the business as much as the iron ore side. So does that make them going through a traumatic period? No, they're growing like topsy. We often see growth stocks on the buy list as well, which is just for whatever reason mispriced.
Good point. Well, the one I'm going to talk about today is going through a traumatic period. So
fair enough.
Particularly the ones that I cover on this show usually are going through all sorts of trauma. But that makes it a fun story. So this is a bit of a crime scene investigation. XIFR committed the ultimate sin. They cut their dividend. Particularly, they had a lot of income investors, and now it's living in purgatory, bit of a halfway house, trying to get its life back together. And I'm going to tell that story, and we'll see if the assets are worth more than its terrible reputation. So this is a really interesting
You sleep
company.
with one goat. Is that that's the narrative?
What's that from?
The joke.
Yeah, but I thought it was from whose routine it was. You sleep with one goat. I can't remember who did the joke. Anyway. So the backstory is XIFR is a bit of a grab bag, sort of a greatest hits album of renewable energy. They don't actually build the assets, they just own the royalties for them. Sort of a landlord model. Now, they own a whole bunch of renewable energy assets across the US, lots of big propellers, lots of solar, and they generate enough they own enough to generate 10.1 gigawatts of power assets across 31 states. Now, not knowing much about that, I asked Google Gemini how to get some perspective around that. It said, well, in Back to the Future, the DeLorean needed 1.21 gigawatts to travel back through time. So XIFR produces enough power to launch 8 DeLoreans back to 1955 simultaneously.
That's a big help.
I thought it was good, because my first question after I asked that was going to be, how much did the DeLorean require? And it knew me well enough to just lead with that. But to put it in more perspective, it's enough to power roughly 3 to 7 million homes.
Right.
More perspective, a standard nuclear reactor usually has a capacity of about 1 gigawatts. The Hoover Dam has a capacity of roughly 2 gigawatts. So these guys produce 5 Hoover Dams. But their business model is interesting. We have covered a couple of electricity companies on the show over the last few months in the US. These guys aren't gambling on daily electricity prices. They're essentially commercial landlords. They sign 15 to 20-year leases. They're called PPAs, power purchase agreements, with utilities. And as long as the wind blows and the sun keeps shining and the tenant stays solvent, the rent check clears. So 10 to 20-year guaranteed income for these things.
So do they own
not a bad business model.
They own the contract but not the asset? Is that how it works?
Kind of. So I'll get into the background of it in a minute. There's sort of a long story with how this got to be built. Basically, they don't build it, but their parent company builds it, and then they have the rights to basically run and operate it and sell the electricity.
So it's a Westfield model. The asset is in one company and the management rights are in another company.
That's it, exactly.
Because the asset trades on a low PE multiple and the rights trade on a large PE multiple.
That's right. So the portfolio mix, if you flew over their assets, you'd mostly see giant white turbines. About 80% of what they do is wind. 18% is solar, and the rest is batteries. 2 to 3% are batteries, which is a nice to have at the moment, but might be the future. Interestingly, we took Fox and a friend, my son Fox and Friends, not the show. We didn't take the Fox show. My son, whose name is Fox, named after Fox Mulder, not Fox News, I hasten to point out, and a friend of his to a local swimming pool in Newmarket yesterday, and I noticed 3 huge Tesla batteries at the pool. Yeah, I was like, oh, that's interesting. Don't know what they're doing with it.
Hopefully they don't fall into the pool, but anyway. Yeah.
They're a long way away from the water, but yeah. I was like, oh, look at that. So the origin story is this company started off as something called NextEra Energy Partners, NEP, which was the golden child yieldco of a company called NextEra, ERA, which is also listed. Their ticker code is NEE. They're the largest electric utility in the world by market cap. roughly 160 to 170 billion dollar market cap. And they launched this venture called NEP, NextEra Energy Partners, a while ago. The pitch was basically, we buy assets, we pay you a fat dividend, stock goes up, repeat. And NextEra Energy goes back to 1925, started life as a company called the Florida Power and Light organization, which then became FPL Group in 1984. It's gone on massive acquisition sprees and, basically built itself into this behemoth of electricity generation. But building things is expensive and messy. You have to take on construction risk, deal with permits, spend billions up front. So they spun off NEP, which is now XIFR, yieldco, to be the perfect home for those assets once they were finished. Logic being the parent does the hard work of building the wind farms and the solar farms, and once it's running and generating cash, they sell it to the child. The child's only job is to buy it and then collect the rent and pay out fat dividends to investors. And that worked very well for quite a long time until it didn't. And when it didn't, they made some changes and investors were not too happy with that. So because it was backed by NextEra, investors treated it like royalty. This, was a spin-off of a very large, very successful, deep-pocketed businesses. And NEP was able to get access to incredibly cheap capital. It had a high stock price, low bond yields. The parent had a massive pipeline of projects. The child company didn't have to hunt for deals. The parents just dropped them in its lap when it finished building these things. It was growth on a platter. And then they had this thing that was basically the infinite money glitch. So the child company would issue expensive stock because investors loved it, paying fat dividends, guaranteed income, guaranteed cash flow to the moon. The child used the money to buy wind farms from the parent. The parent takes the cash and builds more wind farms, rinse and repeat, right? The infinite money glitch.
Yeah. How many times have we seen this story, though? At least I've seen it in Australia, where the bankers get a hold of it, usually with a lot of debt. I'm not sure what the situation is with this one. And it works for a while, and then, something happens and it all collapses like a house of cards.
And what do you always say about growth companies? What's the thing you've been telling me for years? Yeah, it looks great until...
No tree grows to the sky.
Yeah, but you normally have a but, which is always, watch what happens when interest rates go up. Yeah. That's what you've said to me every time.
Yeah.
And that's what happened to these guys too. Mm. So the model only works if the child company has access to cheap capital.
Mm-hmm.
When interest rates spiked, the cost of their borrowing exploded, and suddenly yieldco, NEP, every time I say NEP, I think of the new economic program because I'm a communist. That was when Lenin was still alive, running Russia in the early 1920s. He came up with the NEP when their initial attempts at collective socialism failed. He said, okay, maybe we need to allow a little bit of wiggle room here. And he came up with the NEP, the new economic program, which allowed a little bit more private ownership, which Stalin shut down years later. But anyway.
It's probably why I've never heard of it then.
Yeah, you haven't studied your Russian Revolution. But that's every time I say it, that's what comes to mind. Anyway, different NEP. So when interest rates spiked, cost of borrowing went up. Suddenly they couldn't afford to buy the parents' assets anymore. The infinite money glitch turned out to be a finite money glitch. It kind of broke. And the parent company effectively said, if you can't buy our assets, you're useless to us. The flow of deals stopped, the dividend was cut, and the golden child basically became an orphan. Fun fact, in 2025, NextEra, the parent company, was actually one of the donors who funded the White House's East Wing demolition and building of the new ballroom. So you know where they sit in the scale of things.
They're Florida based.
So, yeah, they are. So there's this red wedding that happened January 2025. Interest rates basically murdered the whole business model. And they did the unthinkable. They suspended the distribution of dividends indefinitely. So the trauma here is people bought this stock exclusively for the income. A lot of funds, income funds, bought it. When they cut the payout, they basically broke the social contract. The income funds sold out, retirees panic, and the stock price crashed. So when you look at the chart, you can see this. It has not been a fun year for these guys at all. Let me bring up my. I just got to bring up my Stockopedia chart here.
Yeah, it's basically a falling knife, isn't it?
Has been, yeah.
Yeah.
Oh, yeah. So if you look at it, you go back May of last year. It was trading around $34-35. It had already come back to the beginning of this year. The beginning of last year, about a year ago, it was trading about 15-16, and then it plummeted in January of 2025 down to about $10, which is pretty much where it's remained ever since, 10.50, something like that, which is where it is at the moment, 10.52.
It was as high as $80, $86 back in.
Oh, if you go way back a few years ago, yeah,
2021, yeah,
yeah, wow. So yes, not a good time for the share price, not a good time for investors, and they are, understandably bailing on it over the last year in particular.
I think I read somewhere that there was a class action going on over that cessation of dividends, and the changes weren't communicated well with the shareholders, or they weren't given the chance to have a say in it.
Class actions in America? Nah, that doesn't seem likely, Tony. Don't think that kind of thing. It's not a very litigious society over there. I don't think that would ever happen.
Art of lawyers.
Yeah. So they renamed the company from NEP. People kept saying, "What's this got to do with Lenin and Soviet Russia?" And they got sick of telling that story.
Said that.
Yeah, everyone knows they're NEP. Socialists were big investors in this. They kept getting confused. So they renamed it to XPLR Infrastructure because that's not confusing. XIFR. They basically put the ticker in the witness protection program and told investors, it's all changed now. We changed the name. It's all different game. But they also said we're keeping the cash to fix the balance sheet. So it's basically an orphaned stock. Growth investors don't want it. It's a utility. Income investors can't own it. It's got no yield. The only people left interested in it are value vultures like us, picking through the wreckage, looking for cash that we can get cheap. And it is a very boring cash engine. The stock chart looks like a heart attack, but the assets are boringly reliable. The wind's still blowing. The sun is still shining. They have 15 to 20-year contracts that people are still paying for. It's a great business model, honestly, whilst they still have the contracts. Even though they're sort of independent, the portfolio was built by NextEra. These aren't hobby farms run by a guy with a wrench. They're institutional grade assets with high uptime. Some of the contracts run out to 2051. So that's long duration cash flow. Even if a recession hits this year, that money is locked in. Theoretically, I guess contracts can be broken and electricity companies can go out of business, et cetera, but we've covered this in other shows recently when we were talking about the guys in California. States need electricity companies to stay in business. So there's all sorts of tricks that get pulled to make cheap financing available to retailers, power retailers, right? Can't afford to have people with electricity. Not yet. Anyway, so the market looks at XIFR and sees a debt zombie. I think they're terrified that the cash flow is just going to get eaten by interest payments and refinancing costs. And some of that fear may be valid. They've historically used financing structures that would make your head hurt, all sorts of big short type convertible equity portfolios, et cetera, that I don't understand. I don't think the market understands. I think that was the point of the Big Short, right? No one really understands how these things work. These convertible structures, they're all designed deliberately to be confusing. The market hates homework. But when you combine complex debt structures with management that just burned everybody, you get a massive discount. But the management is doing stuff with the money, which I'll get to in a second. But the other big question I had is, what about the Trump factor? So this is renewable energy, right?
Yep.
We know Donald Trump doesn't like wind turbines. They kill all the birds. He loves oil. He just kidnapped a president of another country because it's all about the oil, he says. I'm not sure that's true. Yeah.
Well, that was a question I had for you, was whether there was a investor sentiment involved here because of the change in approach or the perception of wind farms has gone down.
I think there may be some of that, but the bottom line is these 15 to 20-year contracts don't care about Donald Trump's view of wind farms, right?
Okay.
They're locked in. So
unless but is there, sorry to interrupt. Are there fund managers who before were predisposed to buy alternative energy generators because they had investors who wanted them, and those investors have shown their true colours and gone back to oil companies or whatever?
Be some of that. I think one of the bigger things, though, is the worry that Trump may shred the Biden administration's Inflation Reduction Act.
Yeah, okay.
Because that's playing a big role in funding renewables. Right. I don't understand the ins and outs of it, but I know that that's part of the sort of headline noise that may be affecting these guys. But if you were looking at this purely from a Trump trade perspective, there is going to be a market knee-jerk reaction to a Trump presidency. I heard about a term that I'd never come across before: buy drillers, sell spillers. You ever heard that?
No.
Yeah. I had to drill down into it. So drillers is self-obvious.
Yep.
Self-explanatory. Spillers. Apparently renewables in market lingo are called spillers because they effectively spill cash on the ground whenever the grid is congested. When you can't stuff any more renewable electricity into the grid, it's just wasting it when you can't stick it in a battery. So, they're called spillers. So buy drillers, sell spillers is sort of the mantra over there at the moment. But, for whatever reason, they're still generating cash despite all of that. I mean, the counter narrative to the Trump trade buy drillers, sell spillers stuff is many analysts apparently believe that a full repeal of the IRA is unlikely because Republican districts are huge beneficiaries of those renewable instruments. It's harder to kill a subsidy if it's going to kill jobs in red states. So then again, I don't really take Trump as the most rational of human beings. So whether or not he cares about that sort of stuff, who knows? But you have to figure it plays into his decision-making at some level. But these contracts that they've got legally binding, whatever Trump thinks is, it's not going to be easy to make these 15 to 20-year contracts disappear. So it's got a near zero immediate impact on existing revenues. The rent checks will keep clearing for the foreseeable future. On top of that, as we've talked about on other shows where we've talked about electricity generation in the last couple of months, data centers, AI, and electrification are driving massive demand for power. Utilities need more electrons, not fewer. They can't afford to turn off the 10 gigawatts that they're getting from XIFR just because of either political rhetoric or because these guys cut their dividends. So the contracts remain and these guys keep generating cash. There's another thing that happened recently. They did end up somehow owning a massive gas pipeline called the Central Penn Line. I think it was an LNG gas pipeline. There was something to do with ESG concerns with some investment funds. For some reason, the LNG was seen to be not ESG friendly. They recently sold that H2 2025 for like a shit ton of money. I think it's like $1 billion or something they sold it for, which they used to pay off some debt. So, they're doing stuff to improve their financial position, getting rid of some of these assets, using the cash to pay down stuff. Basically, I think the Trump presidency might be a valuation headwind, but it's not a revenue headwind.
Mm-hmm.
The market is sort of pricing it as a renewable Armageddon, but the contracts mostly protect against it. The risk is strictly on the future growth math, tax credits for repowering, but not the current cash flow. So the garage sale with Central Penn Line is helping them make a ton of cash. But you have to remember that what yieldco was designed to do, it's a machine that basically eats contracted cash flow and supposedly spits out dividends. And now it's not spitting out the dividends anymore. It's using that money to fix its financial position. So that sucks if you're an income investor or an income fund. But for us, a company that's using its cash to get rid of its debt, that's good. That's all goodness from our perspective, right?
Yeah, exactly. I don't know what the numbers or metrics are for this company when it was paying a dividend, what the yield was, but if it was yielding 5% and it was 100% geared, I don't know what the ratios are, then in 20 years or less, it's paid off all its debt. So it's quite possibly a better use of how it operates than paying off yield or paying off dividends to customers.
It's actually hard to figure out what their dividend yield was before they changed. Yeah. My understanding. So if you look in Stockopedia, it's just got blanks, and I think that has something to do with the ticker code change.
Oh, okay.
As best I could understand it, it sort of confuses the Stockopedia numbers for some reason. But if you look at their financials, I'll get into the QAV numbers in a minute, but if you look at the financials in Stockopedia, there's a few things that jumped out at me. If you look at the average shares down under balance sheet, 2019, they had about 59 million shares. Today, they have about 94 million shares. So in 5 years, they've diluted shareholders by about 60%. They had to keep printing new shares to buy new assets. When the stock price crashed and they couldn't print shares anymore, the machine broke. So, yeah. So now they've got 94 million shares out there, which people probably didn't care for a long time, but now it doesn't look too friendly.
It looks like in Stockopedia too, they were paying off about $3, $3.60 a share in dividends before they cut them.
Yeah. At its peak.
Well, it was last year. It was 2024.
If you go back 5 years ago, it was like $1.97, and then it got up to $3.60, and now it goes to nothing.
But $2 or $3 a share. But if you were again, it requires more analysts. But if you take that $2 or $3 a share on its current share price of $10, it should pay off its debt in a couple of years, really.
Yeah. Well, yeah. So the net debt's about $5 billion, $5.1 billion at the moment. Some other numbers that jumped out at me looking at this, if you look at their cash flow versus their CapEx, operating cash flow is about $8.92 per share. The CapEx, which I figure is just money going out to do stuff, build stuff, is about $7.85 per share. So if they stop spending that on CapEx, which I don't think I thought that they weren't the guys that built stuff, that NextGen built it and they just bought it off them, but I guess they have to repair it.
Yeah.
Would that come under CapEx?
Yes, it would.
Maintenance?
Maintenance, yeah.
So how much of that they can save in their new business model? I don't really know. Instead of having like $1 free cash flow, they might be able to save a lot of money there, which can go to paying off the debt. But there's a lot going out to capex, which I don't really deeply understand where or how they would pull that back. But there seems to be a lot of leeway in there. If you look at the back to the yield line, sort of saying the TTM yield is 9%, but then the forecast is 0. I think that's kind of a ghost yield left over from the last couple of quarters. I think they were, sort of pulled it back in stages. If you look at the balance sheet and the book value per share, $33 book value per share, $33.6 book value per share.
The share price is $10.
Share price is $10. Yeah,
$10.50.
So I assume the book value is the assets that they own, the steel in the ground. So, like, that's crazy to me. You can buy it for a third of its book value. I mean, somebody's got to see the value in that, right?
Yeah, and I don't know. I haven't done the analysis whether the assets are as much the physical pylons and solar panels and wind farms, or whether it's some kind of monetary value assigned to the contracts. So, but either way, they still both have value, and you're buying it for much less than what's on the book out.
For a third. It's insane.
Yeah.
So that's why it pops up in our buy list. So the market cap's around about 955 million. So it's, big enough for most of our investors, but probably small for big fund. It's priced for distress. The PE is about 2.6 times. Price to operating cash flow is 1.14. So long-time listeners know that we look for stuff that's less than 7. 1.14 means you buy a share and it basically pays you back in a little over a year in terms of operating cash flow. So if we use our old cafe analogy, if I could buy a cafe and it would pay me back my buy price in a year and a couple of months, it's pretty hard to say no to that, particularly if it has 15 to 20-year contracts guaranteeing its cash flow, right?
Yeah. And we have to unpack it a lot more. I haven't done the analysis on this that you have, but what are the, use the coffee shop analogy, what are the capex requirements? What are the, where are the risks? What's the debt that you're inheriting? All that kind of thing. But with that kind of operating cash flow, there's a lot of cash to solve all the problems, really.
And look, and again, for new listeners, we don't do deep micro analysis on our stocks. That's not my objective. With my pulled porks, I'm like, okay, this is at the top of our buy list. Wonder why? What's going on? What does it do? Why is it cheap? That's really what I want to know. I don't know the ins and outs of this company's business. I don't care to, but I know that it's generating quite a lot of cash and it has guaranteed incomes for 15 to 20 years, and we can get it really, really cheap. So, let me sum this up. The red flags, to be honest, it's messy. It's very messy. There could be all sorts of things in the financing structure that could come back and bite you. Management kind of needs to navigate this very well. They could screw it up in a number of different ways, but that's always true. Part of our job is trying to find companies that are well managed, and I'm sure the US is not that much different to Australia. We know that very few publicly listed companies are very well managed. A lot of them just a dog's breakfast, and so we try and pick the ones where the management seems to know what they're doing, and if we get it wrong, then we can sell it later on, but finding the ones that seem to know what they're doing. And look, these guys were in a tough situation. I mean, I guess on one hand, you could say interest rates were always going to go up eventually, so having a business model built around the idea of permanent low interest rates was bad. But We had one of Australia's leading financial media commentators on our show 5 years ago, basically saying, this time it's different, Tony. Cheap money forever. The money will flow. Interest rates are always going to be cheap. He didn't say that literally,
No.
but that was the intimation.
He did say this time is different, which is our biggest warning sign. I think that's our biggest red flag.
Yes. Let me run through the numbers just to wrap it up. QAV score of 0.69, which is very high for us. It doesn't score on any of the Stockopedia metrics, quality rank, stock rank, F score. Couldn't score for any of those. The price was less than both our IV number 1 and our IV number 2. It's also less than book price and, of course, book plus 30. Doesn't have a new 3-point upturn, but the book value growth is positive. And, well, this is a tricky one. Is PE less than the yield? Yes, but we know it doesn't have a yield moving forwards, but looking at the numbers where they were, it did score for that. The forecast IV is greater than twice the current share price. PropCAF is less than 7, as I said. So in our scoring, it got an 11 out of 14, which is a quality score of 79%. Stockopedia gives it a quality score of 30%, but ours is scoring differently, obviously. And as I said, a QAV score of 0.69. So that is XIFR. On the top of our buy list. I am going to add it to our Light portfolio this week, and we'll see how it does.
I think one last thing to add is that the sentiment seems to be bottoming out, if not turning, if you look at the stock price. So, it's back above its buy line, it's above its sell line, and it's been slowly increasing off a base. Now, the trend could easily break and we'll have to sell it, but I'm guessing it's found a bottom in the market at the moment.
From your lips to Trump's ears, Tony, we'll see what happens. I'll just wrap up by looking at our US portfolio. It's been a good month for our US portfolio. It's up about 5% in the last 30 days versus the S&P 500 up 0.46%. But for the last 1 year, we're still down. We're negative 13% for the last 1 year. But as I say every year, every show, that's because we had an absolute ridiculous year the previous year where we were up like 100% for the year. So it's come back a bit. Since inception, which is since September 2023, our US portfolio is up 68%. Versus the S&P 500 up 55%. So we're doing quite a bit better. Not double market yet that we would like to see, but as I said, it was triple market going back a year ago. Came back a bit over the last year with interest rates and different things going on, but some of our stocks have continuing to do very well. WLFC is up 200%, ENVA is up 172, ESEA is up 93, BLX is up 80, etc., etc. Korea Electric Power that we added a while back, a few weeks ago, is up 6% since we added it, by the way. So that was a nice call. The stocks that I've added to the Light portfolio over the last couple of weeks are both down a couple of points. AMCX is down 3%, GTN is down 3%, but it's early days with that, so I'm not really fussed at all. And I will add XIFR, and we'll see how it goes. So that's TK.
Was he the guy who did the pan pipes in Picnic at Hanging Rock? Was his name XIFR? Remember the theme from Picnic at Hanging Rock, the soundtrack?
No,
or was
I
he
don't
playing,
remember.
Or was he playing a XIFR?
I think it's XIFR as an instrument.
Yeah.
Like a mouth harp?
That's it. I think, yeah. Every time you kept saying it, I kept picturing it. Yeah, Picnic at Hanging Rock.
I haven't seen that since I was a kid. Yeah. All right. Well,
Okay.
that's the show for this week. Thank you, TK. Thank you to our listeners, and we'll be back next week with another American stock to take a look at. Do your own research, though.
Thanks, Cam.
Thanks, TK.